Have you ever wondered what's the role of central banks in financial stability? Central banks are extremely fundamental financial systems as they are the core financial systems for every nation. The primary reasons for the existence of central banks are: first, price stability. This implies that the central banks maintain a very low inflation target. Second, economic growth. Central banks target at growth without causing imbalances. Third, financial stability. Central banks are required to take measures to ensure that financial systems do not disintegrate. Central banks achieve a stable economic environment beneficial for the country because it encourages economic growth and enables the creation of jobs, creating wealth over a long time. The importance of central banks in financial stability. Central banks are crucial to the effort to attain financial stability as they go a long way in preventing the financial system from risky tendencies. The primary objectives of central banks are proper control in inflation, ensuring liquidity in the times of limited inflow, and easy flow of funds.
Central banks play a key role in financial stability through monetary policy, which aims to stabilize prices and control inflation. This is done by adjusting the money supply through open market operations, such as buying and selling securities. These actions influence short-term interest rates, which affect economic activity. Lowering interest rates can stimulate growth, while raising them helps curb inflation. Central banks also act as the lender of last resort, providing emergency liquidity to struggling financial institutions. This function is vital for maintaining financial stability and preventing crises. It helps sustain public confidence and prevent widespread disruptions. However, it must be handled carefully to avoid moral hazard, where institutions take undue risk relying on central bank support during crisis.
Regulation and supervision. The central bank is the supervisory and regulatory body for banks and plays a role in regulating the financial sector in the kingdom and setting goals. Its tasks include regulating the foreign exchange market, and its goal is to protect the stability of the local currency. Market potential policies are a set of measures that aim to reduce risk and stabilize the market, so they must pay attention to the interest rate because it affects inflation and the economy. And the international level, a set of tools has been issued to combat any shock. That set of tools is 1. Financial institution, 2. Customer sector. Tools that central banks use to ensure financial stability. The IMF is Financial Assessment Program help central banks analyze and assess the financial sector.
During financial crises, central banks aim to limit economic damage by calming markets and ensuring the flow of credit. Their tools included: first, liquidity support, providing loans against good collateral at penalty rate and extending this support to non-bank institutions when it's needed. Second, lowering interest rate to stimulate demand if rate hits the floor. Unconventional measures such as promising prolonged low interest rate or breaching assets can further stabilize the market. Third, flexibility and collaboration, easing corporate requirement, arranging currency swaps, and working with financial authority to obtain additional support such as government-generated or capital injection. Central bank has a role in market infrastructure through several things. 1. Currency stability. 2. Payment system regression. 3. Lender of last trust. 4. Market regression. 5. Innovation support. 6. Transparency standards. This role fosters financial stability, lower systemic risk, and support economic growth.
In conclusion, by setting target interest rates and determining the optimal amount of money which should circulate within the economy, they attempt to keep inflation under control and assets output and employment by creating conducive environment.